I always like to start the show with a summary of kind of what we saw happening in the stock market this week and really kind of, uh, I think this is important because a big chunk of what happens for retirement is your asset management, your ability for your assets to continue to grow, to keep up with inflation, make sure that it doesn't have, a big drop and those types of things. Retirement planning is another component, and then tax planning. We look at those kind of the big three.
Hmm.
And so look at this S&P 500 chart. So this is the very beginning of this chart was the very high that we've had, all-time high at the beginning of 2022. Came down all year in 2022, basically. Hit a low on October 13th of last year. And we've been riding up ever since, and really to the consternation of Wall Street for the
Yeah.
most part. I mean, if you look at what has been going on in terms of the analyst projections, the economists, you look at all of the different articles and things that have been coming out. This wasn't supposed to happen.
Nope.
No,
We're supposed to be in recession by now.
yep. Matter of fact, I would say the big consensus by the end of last year was that we were going to be maybe 20% below that low point that we hit in
Hmm.
October. And so here we go. We continue to kind of get on the other side of that. And we've been pointing out, I think the pluses and minuses that have been happening in the economy all the way through. But, we had a checklist of things that we needed to see before we felt like we'd had a primary change of direction. All of those things were accomplished really back in May, early June, and
Yep.
we've had just a phenomenal run ever since. And one of the things that I think is important to understand about the market is you have to be really careful with kind of what you read out there and what you see. I get lots of articles from clients saying, oh, what do you think about this? And, most of the times they're negative. Obviously, negative articles get more views than positive
Yep.
articles. And so there are a lot more of them out there, and something that's scary and the dollar is going to disappear or whatever it might be. I think one of the things that's important is to take a look at this chart.
Hmm.
The thought process of that is that, it is in the price. That's kind of something I'm telling myself all the time, which just means that as I look at the price of the S&P 500, for example, here, it is telling us something, right? It is telling us that things could be decent here. We've now reversed fortune from a bear market, which is 20% or more down, to a bull market, which is 20% or more up. That's a really big deal. The shortest bull market we've ever had is 2 years, and we're really just kind of getting started with this. So there's some reasons why these things are happening and why things are getting better, and there's some risks, and let's talk about a few of those.
Hmm.
So one of the things, and let me switch views here so we can see this a little bit better. One of the things that's happening right now is this artificial intelligence, piece.
Oh,
And
yeah.
really, NVIDIA, who reports very late in the earnings season, kicked this off, and they had a fantastic report, a big jump in their stock price, and it really everybody started looking around. So who else has that?
Hmm.
Microsoft, Apple's getting involved with it, Google, and we're seeing all of this artificial intelligence piece coming. So we're in what's called the hype cycle, which is
Hmm.
this beginning piece. We saw this with the .com, we saw this with clean energy and those types of things. So there's kind of this perceived market opportunity there at the top. People can say, wow, this artificial intelligence can do all these great things. Here's how that's going to play out. And it really probably overprices
Yep.
things, because the next downward trend there is that facing reality. So eventually, at some point in time, this artificial intelligence piece is going to kind of face that reality. Some of these companies will fail. You see, get washed out. And then the actual reality comes in, and it actually often turns out to be higher.
Hmm.
I mean, a great example out of the .com piece is Amazon.
Yep.
Yeah. And so we're in that hype cycle. Now, keep in mind that you can make great money in the hype cycle. You can have a pretty substantial run. I mean, I've forgotten where NVIDIA is now, but the last time I checked, it was up over 180% year to date, doing pretty decently.
Yep.
And so that's a pretty good hype cycle. But it is important to kind of understand where you're at. So we're not in the AI is going to go forever straight up cycle, in my opinion. And so, we want to watch that, and that's why we watch the price. We watch what's happening. So we watch the price of the S&P 500, like I showed already in the previous slide. Well, obviously things are going okay there, but if we see deterioration, we also watch the price in some of the artificial intelligence stocks and some of those ETFs that are in that arena. And we have a list of 175 ETFs that we use, and we can see things perking up to the top and then falling out of that top spot, and we rotate based on that. So I'd be a little careful to kind of buy in on AI permanently because there's going to be some washout that happens here. But I actually think we're still early in this cycle.
Hmm.
Yeah, in the hype cycle. So it's kind of a risk, but it's probably a good thing at the moment.
And the nice thing about AI too is it's a lot of mega cap big tech. It's
Yeah.
not like these small startup companies. It's well established companies. They're getting
It really is, and they're the ones probably going to benefit from it also. I wouldn't be surprised to see a lot more small companies pop up, because that kind of happens, once things get going and what have you. We'll be reading about those. But again, that to me, that also means we're kind of early in the cycle. It could have some legs here, could have some room to run. Inflation's the other big threat, of course, especially a resurgence of inflation. It's kind of not really expected. Here is the CPI index for the last 3 years. This is the top line, includes everything, including food and energy. Well, this was reported, last week in 2.97%. Pretty good.
yeah.
Really, really nice. I mean, and that chart looks fantastic to me. Looks like it's actually coming down slightly faster than it went up. It hit a peak of a little over 9% back in last June, so that's good. However, we are seeing kind of core consumer price not quite as good. Although I will say, if you look at the very last report here, that's a pretty nice little drop down.
Yeah, it finally broke through that kind of lull it was in.
It did, and hopefully that continues down. Although we're going to probably see some pressure on food prices with what's happening in Ukraine, with Russia going after the grain ships and those types of things, because wheat and grain is a big product out of Ukraine, and it's certainly a big product worldwide.
Yeah, we are seeing a spike in the commodities market.
Yeah. It's been surprising to me that the Russia situation, the Ukraine situation, hasn't created more inflationary pressure. It has created some, but the very dire projections when it first started in February of 2022 haven't played out. Energy market and those types of things. So we'll see how this plays out. But you can kind of see here that core inflation, which is a more important component as far as the Federal Reserve is concerned, is still kind of hanging in there. Again, it's a little bit better right now, and so the market's reflecting that, but it's something to watch for as far as the risk goes. Now, what's the Fed going to do? Okay, I'm sorry you can't see this very well, but this is it's called the CME Fed Watch tool, and it's basically looking at the futures market for what's going to happen. The Federal Reserve meets next week. What are they going to do? Are they going to raise rates? They're not going to raise rates? Well, it's 99.8% bet right now.
Yep.
That's the highest I've seen, I think, that we're going to have a rate increase next week, right?
Mm-hmm.
Get another quarter point. But because these CPI numbers, the inflation numbers have been so good, we're starting to see a lot less anticipation of a second rate increase.
Mm-hmm.
They do have some time, too, which I think is important because there's no meeting in August. They do go to Jackson Hole in Wyoming. They usually have some, I'll call it a speech that Chairman Powell might do, and then their next meeting is actually in September. I think that gives even more time for that inflationary pressure to maybe come down, or if it's going to come down.
The Fed to do a wait and see approach, which is nice.
Yeah, their projection was for 2 more rate increases this year. Market is saying 1 more. Almost 100% chance it's going to be the next meeting, and really no other increase this year. Bernanke, the former Federal Reserve chairman, came out, yesterday, and said that he didn't feel like they'd probably have another increase for quite some time after this one. So that's good. I mean, because if we go back to this, direct correlation to lower inflation and a stock market that's going up. Yeah.
Mm-hmm.
I mean, so as long as that continues, this probably continues to hold up pretty well. So the next thing we want to look at here is just kind of all of this talk about recession. We have to keep in mind that employment as a whole is a lagging indicator. That's really important to understand. I keep getting clients talking about, how well things are going here, but this is really good, right? I mean, we're not seeing any cracks in the employment picture. Matter of fact, first-time unemployment claims that have every week were really lower than expected this week. The market kind of responded negatively to that.
Didn't like that.
Yeah, because again, that's tight labor market creates higher inflation and what have you. But here's the number of people working. Well, we're back above where we were prior to the pandemic, which is fantastic because one of the tightest things that we have going on right here is this labor piece. We don't have enough people for the demands that are happening right now
Mm.
for this pent up demand. Well, they can see it's steadily coming back, right? That's nice. Then we look at the unemployment rate. Wow, it's really low. This is going back to the 1950s. The last time it was this low was 1969. So really, really strong labor market creates some inflationary pressure potentially, but really creates some pressure to keep inflation away also.
Yep.
I mean, sorry, recession away also. So, you know, it's really hard for me to see a massive recession happening in the very short term here when you have so many people employed and you have so many job openings. Now, this is going back to 2000 here on the number of job openings. And you can see here that, obviously we've got a situation where it's slowing down. Yeah, job openings coming down, but look at how high it is compared to where it was before. I mean, it's ridiculous how many jobs are open
Yep.
right now. Now, a lot of these are in the service area. Maybe they're not the highest paying jobs or what have you, but they're still there. And having them come down from that high that we set back there is actually again a good thing because this is going to take some of the inflationary pressure away. So it's a really, really good scenario so far. I mean, it really has played out well. The things that are slowing down, so here's an analogy. You got 1,000 people lined up for your business outside the, doors. Okay, great. You got a lot of pricing power. You can do a lot of things. Now you're down to 10 people lined up outside the doors. You're still busy. You're still
Yeah.
doing business, you know?
But you just can't raise your price as much. And I think
Yeah,
a lot of companies in the earnings reports are saying that is that
right.
we can't really push our profit margins any further. We kind of find that like we're getting this. People aren't willing to pay the price anymore.
Yeah, and I think what's happening there, you're going to see some compression here of earnings because if you can't raise prices and some of your costs are still going up, labor costs and whatever it might be, in order to get the people to come to work, you should see some compression of earnings. That will create some issues for the stock market.
Yeah.
And I've been talking this week about a period of consolidation where the market can kind of go sideways or come back a little bit or what have you. I think we're due for that. We just had such a strong run in such a short period of time. Here we are in earnings season, and I think that might be what causes that consolidation is some of those comments that are coming, whether that's happening right now in the second quarter that they're reporting on, or it's going to happen in the next quarter, when
Yeah,
they
the
give their
forward
forward
guidance.
guidance. So I think that's happening. So lastly, we're in a bull market. That's a big deal. And so, the shortest bull market is 2 years. The average is 5 years. The average rate of return is 177%. We have a ways to go on this particular bull market potentially just to get to the average or even the shortest one. I think the shortest one was 50-60% rate of return.
Yeah.
So anyway, keep all these things in mind. I think it's really important to kind of have an idea of what's happening with the market and the economy right now. Things are still pretty good, but don't be surprised to see some softness coming up here just because we've had such a big run. We're in the middle of earnings season. They're going to raise rates next week. Those types of things that I think are going to create some softness. But I think the basics are still there to kind of keep this rolling and keep it going. There's an awful lot of money that was sitting on the sidelines that missed out on a huge part of this run.
Yeah.
That's still coming in. So anyway, that's our summary for the week. Really appreciate you joining us for that. Look forward to being able to talk to you the next time. We will not actually be here next week. We will be here the week after. All right.